Tulip Mania, 1630s. Cause: in the Dutch Republic, rare tulips became luxury status symbols. People started buying bulbs not to grow flowers, but to resell them at higher prices. What it looked like: imagine buying a flower today for $100 because you're sure you can sell it tomorrow for $200. Everyone believes prices will keep rising. At the peak, a single bulb could cost as much as a house or a year's salary. How it collapsed. Eventually, buyers stopped showing up. Once people realized they couldn't resell at higher prices, panic began. Prices crashed almost overnight. Consequences: many people lost their savings. Tulip Mania became the classic example of a financial bubble driven by speculation and crowd psychology.
Panic of 1873. Cause: railroads were the future technology of the 19th century. Investors poured money into railway construction, and banks issued massive loans. Simple example: it's like everyone building shopping malls in one city. At first, it's profitable, but if too many are built, they stop making money. What happened? Several major railroad companies failed. The banks that financed them collapsed as well. Fear spread quickly from the United States to Europe. Consequences: this triggered what became known as the Long Depression, a global economic slowdown lasting several years. It showed how interconnected global finance already was.
Panic of 1907. Cause: a failed attempt to manipulate the copper market shook investor confidence. What happened next? People rushed to withdraw their money from banks, but banks only keep a fraction of deposits in cash. Simple example: if every customer shows up at the same time asking for their money, a bank can't pay everyone immediately. Consequences: the crisis exposed weaknesses in the US banking system. As a result, the Federal Reserve was created in 1913 to act as a central bank and stabilize the system during crises.
Great Depression. Cause: during the 1920s, people heavily invested in stocks, often using borrowed money. The market seemed unstoppable until it wasn't. Simple example: someone buys stocks with borrowed funds, expecting prices to keep rising. When prices fall, the debt remains. What happened? In 1929, the stock market crashed. Banks failed. Businesses closed. Unemployment reached around 25% in the United States. Consequences: millions lost their jobs and savings. Governments began playing a much larger role in managing economies and regulating banks. 1973 oil crisis. Cause: members of OPEC imposed an oil embargo during geopolitical tensions in the Middle East. Simple example: if gasoline suddenly becomes scarce, prices surge, and since oil is essential for transportation and manufacturing, everything becomes more expensive. What happened? Oil prices quadrupled. Inflation rose sharply while economic growth slowed. Consequences: the world experienced stagflation. High inflation combined with weak growth. Countries began seeking alternative energy sources. Black Monday. Cause: stock markets were overheated and computerized trading systems automatically sold stocks when prices fell. How it escalated: prices dropped, computers triggered more selling, prices dropped further. It became a snowball effect. What happened? On October 19, 1987, markets fell more than 20% in a single day. Consequences: regulators introduced circuit breakers to temporarily halt trading during extreme market drops. Asian financial crisis. Cause: several Southeast Asian countries borrowed heavily in foreign currencies while experiencing rapid growth. Simple example: if a country borrows in US dollars but its own currency suddenly loses value, repaying that debt becomes much more expensive. What happened? Investors panicked and pulled their money out. Local currencies collapsed, banks failed, and economies shrank. Consequences: the region suffered deep recessions. Countries later strengthened financial regulations and became more cautious with foreign debt.